I'd like to introduce you first to Isabel Kwok from JM Fin. JM Fin have joined us as a new supporter this year. We're delighted to have them, and this is our second webinar event with them. And already we're seeing some really good engagement with them, and we're hoping that over the course of the coming year, that's only going to increase. And I think Isabella is going to tell you about some other things that we're going to do coming up next year. So I'm going to hand over to her so she can tell you a little bit about JM Fin, and then she will then hand over to Anna, who is your speaker today. But welcome, Isabel and Anna.
Thank you. Thanks, Helen. Good afternoon, everyone. We're really pleased to be able to offer our second educational piece to the Bristol Law Society members. For those that aren't familiar with JM Fin, we offer personalised wealth and investment management services. We have about 18,500 clients predominantly in the UK, and we manage about 11.5 billion assets under management for those clients, primarily on a discretionary basis. Having acquired a number of teams recently, we are now up to 83 investment managers across our 6 regional offices, the most recent of those being our brand new Cheltenham office, which is very recently opened. The Bristol office was established over 20 years ago, and we manage about £1 billion worth of assets here. There are 11 investment managers that work in our local office, and some of those are the founding members that set the office up over 20 years ago. As strategic sponsors, we're really keen to develop more links with the local legal professional network, and we've got an exciting pipeline of events lined up. The next one is the seminar in mid-January on the outlook for the markets in 2026, which is going to be run by our very knowledgeable head of investment team called John Cunliffe. So if you have investments or you're interested in investments, if you have clients that have their own investment portfolios, then that's probably an event that you should be attending, and please do spread the word with your colleagues as well. We're really keen to organise more collaborative events, so if there are any subjects that you would like to hear more about, then please do get in contact either with the Law Society or with us directly, and we'll look to include that in our schedule going forward. So I'm going to hand you over to my colleague Anna Murdoch, who is the head of our wealth management service at JM Fin. She's going to explain how offshore bonds can be used as an alternative vehicle for tax planning. And that's particularly relevant now that SIPPs are losing some of their benefits of inheritance tax. So I'm going to hand you over now to Anna without further ado. Thanks.
Thank you, Isabel, and thank you, Helen. So as Helen mentioned, my name's Anna Murdoch, and I head up the wealth planning team here at JM Fin. So we work with the investment managers such as Isabel in providing the clients of JM Fin with financial planning advice as and when they require that. And that can include the investment wrapper, which is called a offshore investment bond. So Isabel and I just thought it would be a useful session today to go through in a bit more detail what are these products, how do they work. So I'll talk you through now what we're going to cover. We're going to give you an overview of offshore investment bonds. Then I'm just going to talk a little bit about who they're suitable for. So who should be using these products and potentially who shouldn't be. And then we'll cover the main features of offshore investment bonds, the points to note. We've also got some case studies throughout the presentation and how these wrappers can be actually applied in practice. We'll talk about the taxation, which is unusual compared to other investments in the UK, and different relief mechanisms that are available on these type of plans. And at the end, we'll cover off, as Helen mentioned, any questions, so do feel free to submit those. We've had a few already in, which is fantastic. If we do run out of time, then we will, of course, come back to you and answer all your questions individually. We'll also cover the points to note about offshore bonds. So the things to be aware of, effectively the cons versus the pros that we will cover. So let's start at the top. What is an offshore investment bond? Well, simplistically, it's a single premium investment wrapper provided by life insurance companies in low tax or tax neutral locations. So they would be, for example, the Isle of Man and Dublin. They first appeared, offshore investment bonds, actually back in the late 1970s and early 1980s. And they were mainly set up by UK life companies establishing new subsidiaries in low tax jurisdictions. And you might be wondering why this happened in the 1970s. Well, for those that do remember, UK income tax in the 1970s could reach up to 83% on earnings at its highest level, which was extraordinary, and actually 98% on investment income for the real for the individuals with the largest level of income. This was the highest in modern history. So offshore bonds emerged in that environment as a legitimate way to defer tax and protect investment growth. So the key features of offshore bonds, well, as mentioned, the first thing to note is that they are funded by a single premium. They're not really suitable as a regular investment. They should be funded with a lump sum of capital in the form of cash. They can be topped up, and we'll talk a bit about that later on. The main benefit of offshore bonds, and what some of you are probably already aware of, and why they can be attractive for tax planning, is because they offer tax deferred investment growth. So there's no tax on the investment growth until withdrawals are made, which allows tax deferred compounding. It means investors can maximize returns by deferring the tax liabilities. And this provides flexibility to manage when and how taxes are paid. So investors really can control the tax point on these type of wrappers. Another publicized feature of offshore bonds is the fact that they also allow you to withdraw up to 5% per annum of the original capital on a tax deferred basis. And that's without any immediate tax liability. There's also a useful carry forward feature that 5% withdrawal is cumulative. So if the 5% allowance isn't used in any given year, it can be carried forward to future years. So you can see here we've got a couple of very simple examples. The person invests 100,000 in an offshore bond, and they can actually just decide to take out £5,000 a year, tax deferred. And that can continue if they took 5,000 a year out for 20 years without any tax being payable. It's not accurate to say it's tax-free. The tax is being deferred until the bond is ultimately encashed. If no withdrawals are made for the first 5 years, the unused allowance accumulates. So, for example, investor invests 100,000 into an offshore bond, doesn't take out any withdrawals in the first 5 years. They can then actually withdraw up to 30,000 in year 6, which is obviously £5,000 times 6, without incurring any immediate tax liability. The 5% withdrawal facility as well, that can be taken monthly, quarterly, annually. So it's also fairly flexible. A very important point regarding offshore bonds, which some people aren't aware of, is that they're actually subject to income tax on encashment of the wrapper, not capital gains tax. So they are different to most other investment vehicles that are subject to taxation. Another feature of offshore bonds is they are segmented. So you tend to find when you take out one of these products that they're written into lots of segments. So typically an offshore bond might have 1,000 segments within it. And this is a great feature of them because it gives flexibility to cash in individual segments instead of the whole bond. And it allows withdrawals to be managed tax efficiently and the gains to be spread over a period of time. So each segment represents a small share of the bond's total value and growth. So for example, we have another example here. I think the examples are important in this webinar because offshore bonds can be quite complicated wrappers, and I think the examples and the case studies we've got hopefully will bring it to life a bit more. So an offshore bond valued at £100,000 consists of 100 segments, for example. The bond started off with a single premium of £50,000 and is now worth £100,000. Each segment, therefore, has a value of £1,000. So the investor could choose to invest in cash if they wanted to, only one segment. And that would give them £1,000. And the gain on that segment, which would be the taxable amount, would be £500. So you can see how allowing an offshore bond to be written into as many segments as possible is a very useful tax planning feature. And when we are advising clients on this type of wrapper, we do usually instruct the provider to set up the plan with as many segments as possible. Linked to that, segments can actually be assigned to another person with no immediate tax liability. So I can gift a segment to you and there is no tax at that point. Effectively, the features of that segment and the tax are carried over to the new individual. As long as I gift you the segment rather than you buy it from me, there's no immediate tax liability. And you can do that to anyone who's aged over the age of 18. You can assign segments to individuals, to trusts, etc. Offshore bonds can also be placed into trust, and they do suit certain types of trusts. And we're going to talk in a bit more detail about this in a further slide later on. Sometimes the providers offer specific types of trusts, for example, discounted gift trusts, loan trusts, gift trusts, or alternatively, the client will set up a trust with their solicitor. And the solicitor and the client may discuss the types of investments to have in that trust and what would suit the trust. And an offshore bond may be a wrapper to select there depending on the type of trust. And what investments are allowed in offshore bonds, just to add to this, they will typically have collective funds in there. So it might be investment trust, OICs, ETFs, etc. Also, discretionary investment managers can be appointed to manage a offshore bond. So, for example, JM Fin will have a client who will have typically an ISA with ourselves, maybe a SIP pension managed by JM Fin, but they could also have an offshore bond that we manage as well. So, who offers offshore bonds? I think it's important at this point just to note that the providers stipulate that these products are a advisor product. So they do have to be arranged through a financial planner. They are not a product that a individual can approach a provider and do directly. The providers of offshore bonds, notable ones now currently in the marketplace, include Standard Life, Canada Life, Utmost, and RL360. You'll see a lot. These firms are some of the large insurance companies in the UK who have set up offshore subsidiaries. But it's interesting, the number of providers of offshore bonds has shrunk sharply since the early 2000s. In the 1990s, there was probably around 25, 30 providers. Now that has decreased. There's been a lot of consolidation in the industry, and there's probably around 10 providers now across different jurisdictions, mainly Isle of Man and Dublin. There's been major consolidation. So, for example, some people may remember Royal Scandia, that then became Quilter, and then Quilter was acquired by Utmost. So, for example, Utmost has offshore bonds run by various legacy providers. And Utmost then also went on to acquire AXA Wealth, who were a large provider of offshore bonds. So what's the target market for offshore bonds? Who are they suitable for, and who are they not suitable for? And I would say they are a reasonably niche product in the UK. And this slide really gives you some examples of when we will consider them for clients and when we think they're suitable. So they really suit long-term investors. So it's those who are able to invest over many years, who are seeking a long-term investment growth. They can afford to invest the capital and let that grow over the long term. They're seeking sustained investment growth with the tax deferred feature and the compounding effect that gives their investment. Investors with lump sum capital, as I mentioned, they typically suit someone who has a large lump sum to invest. And it may be that they have sold a property, sold a business, for example, other assets, and they've come into some capital and they want to look at investing that over the long term. Typically, they are suitable for investment amounts of above 250,000. They don't tend to be suitable for smaller investment amounts. We would look at other investments for that. They're also not really suitable for regular contributions. You would want to make a lump sum contribution into an offshore bond because of the way they're structured with the segments and the withdrawal facility, etc. They are really suit high net worth individuals and high income professionals because those people are obviously paying 45% income tax, and they will be looking for investments where they can defer that. We would always look at, for example, ISA and pension funding for high net worth clients, but once they've used their other allowances, we then look at other wrappers that may allow them to defer the tax. So it allows high net worth individuals to control the timing of taxable events and defer that tax on their investments to a point in the future where either they may be a lower rate taxpayer, or they may decide at some point in the future to assign segments to someone else in the family who's a lower rate taxpayer. Offshore bonds are also very suitable for clients who have fluctuating income each year. So there may be some years, for example, where they are paying 45% tax, they're paying a large amount of income tax, and other years where their income is low. They could be self-employed, they could do project work, for example. Offshore bonds and the tax deferred 5% withdrawal facility work well then, because in a high income year, the individual could, for example, if they wanted to top up their income for any reason, take out a 5% withdrawal from the bond. But then in a low income year, they may decide to encash segments of the bond and time the income tax and pay the income tax in those years. So they're useful for people with fluctuating income. Also, individuals seeking to save for their children. They're looking to pass on their wealth in the future to the next generation. Then assigning segments at a later point of time can be a very useful facility. And this is where we see offshore bonds used well for planning, in the sense of you may have someone who's working, additional rate taxpayer, has capital to invest, invests the money in an offshore bond, benefits from that gross roll-up of no no tax being deducted. But then, for example, in 15, 20 years' time, they may decide to assign some segments to their children who are then adults, and the original investor client has had the benefit of that gross roll up of the investment returns, and then the tax then passes to the child. So the adult child can then encash segments and use their allowances and their tax rate, which is probably going to be lower than the original investor. So you can see there the benefits of this tax planning. Those individuals with inheritance tax concerns and people looking to minimise estate taxes, because offshore bonds can be assigned into trust if it's suitable to do so. Linked to this, trustees can use offshore bonds as an investment vehicle, and they do fit naturally within some types of trusts, particularly discretionary trusts. They offer tax deferral, offer simplified administration and reporting, and the trustees can opt to assign segments to the beneficiaries as well, and use the beneficiaries' tax rates. Court of Protection and deputy cases as well may consider an offshore bond. We have some Court of Protection portfolios at JM Fin, and some of these can be quite sizable, unfortunately, if they are linked, for example, to medical negligence, etc. And because of the size of some of these cases, they are designed to support the individual affected for their lifetime, then we may consider an offshore bond for some of their capital, particularly if their income from other sources is going to be quite high. So next we're going to look at how these wrappers are taxed. Now, as I mentioned, the main point here is they are subject to income tax. So any gains from the offshore bonds when you encash the bond or segments within it, or in fact, if you go over your 5% withdrawal allowance, they're taxed at the bond owner's marginal rate of income tax. So that will be 20% for basic rate taxpayers, 40% for higher rate, and 45% for additional rate taxpayers. So, for example, if an individual has total income of £25,000 and they have a chargeable gain on an offshore bond of £10,000, then that gain would be taxed at 20% basic rate tax, and they would pay £2,000 on that encashment. Offshore bonds do allow tax allowances to be utilised, and importantly, they are treated as savings income. So they can allow an individual to use their income tax personal allowance, which we all have, which is currently £12,570. Potentially, depending on the individual's other income, they would also qualify for the starting rate for savings, which is £5,000. This is a special 0% tax band effectively with people with low earned income. So you only benefit from the starting rate for savings if your non-savings income, such as salary, pension, etc., is below the personal allowance. There's also the personal savings allowance, which lets most people earn some interest on savings tax-free on top of any other allowances. For this tax year, basic rate taxpayers benefit from £1,000 of savings, interest tax-free, and higher rate taxpayers benefit from £500. Additional rate taxpayers do not receive a personal savings allowance. So if you have an individual with low or no other income, clients can actually achieve up to £18,500 of tax-free income from offshore bond gains. Now, in reality, that's only likely to be applicable in our experience when we are assigning segments to adult children. For example, they may be at university, they don't yet have any earnings. So that's when this planning can work really, really well. So there's a specific type of relief available for offshore bonds, which is it's called top slicing relief. And this top slicing relief basically smooths out the tax on large chargeable event gains from offshore bonds. So what it does is it treats the gain as if it had been earned evenly over the policy years, not all in one go. So the gain is divided by the number of policy years to find an average slice. And then that slice, the tax is then calculated on that slice, depending on in which tax band it sits for that client. And we'll come to some examples of this to explain it. The tax on that slice is then multiplied back up by how many years the bond's been in force to give you the overall tax due. You see that reduces the overall tax rate if that full gain had pushed someone into the higher rate tax band. It can actually lower or remove higher rate tax. A couple of important points on top slicing relief. It's not available to trustees of trusts, and also it doesn't restore the personal allowance. So you have a personal allowance of about £12,500 for income tax, but when your total taxable earnings exceed £100,000, you start to lose that personal allowance. If you have a gain on an offshore bond and the total gain takes you over £100,000, then top slicing relief cannot be used to restore your personal allowance. It's only used to look at what tax will be due on the gain. So let's bring this to light a little bit with an example of a client here who is looking at top slicing relief. So we've got John who wants to cash in his entire offshore bond, but he is concerned about the tax implications. You know, these are quite complex products. He wants to know if the gain's going to push him into the higher rate tax bracket, that 40% bracket, which is applicable on taxable income of above approximately £50,000. So John's age 60, he's a UK resident, he's a basic rate taxpayer. His current earnings are about £30,000 per year. He invested in an offshore bond 10 years ago with £100,000. It's now worth £160,000, so there's been a gain there of £60,000. If we look at the top sliced gain, the total gain's the £60,000. It's been held for 10 years, so the top slice gain is £6,000. The gain divided by the years held. So we add that top slice gain of £6,000 to John's other income. So that's 30,000 plus the 6,000 to give us 36,000. So you can see John remains within the basic rate band. As the top slice gain does not exceed the higher rate threshold, that top slice doesn't take John into the higher rate threshold of above 50,000. John avoids paying higher rate tax on the whole gain. So we then times the top slice gain by 20% to work out the tax. So you have £1,200 tax due on that top slice of £6,000. And you then times that tax on that slice by the number of years in force, which would be £12,000, would be due on the whole gain. If we just added the full gain to John's other income, so if we just added 60,000 to John's other income of 30, the tax would be just shy of £20,000, whereas with top slicing relief, the tax is £12,000. So you can see the tax saving there is about £8,000 because that top slice has kept John within the basic rate band. And as mentioned earlier in the slides, offshore bonds can be assigned to another person. This can be a family member. Typically, it might be spouse or adult children. There's no tax at the point of assignment if that is a gift to another individual. There would be tax if segments were bought from somebody else. So when you assign segments, effectively you're just passing on the history of the bond, the gain, onto the person you've gifted the segments to. So after assignment, all tax liabilities on withdrawals are transferred to the new bond holder. Assigning the bond to a lower rate taxpayer can reduce the tax liability, or assigning to a non-taxpayer can eliminate the tax liability altogether. So we have a high rate taxpayer who will have earnings above £50,000. They have a gain on a bond of £10,000. So they decide to assign that bond to their spouse because he or she is a lower rate taxpayer paying basic rate tax. So the tax liability on that gain is reduced from 40% to 20%, resulting in significant income tax savings. We've just got a case study here, excuse me, of a client who looks to assign segments to one of their children who's age 20 to help fund a property deposit, for example. So say we have an offshore bond segment value of £20,000. The offshore bond segment originally cost £10,000. That was the premium in. So the gain on each segment is £10,000. We've kept these examples intentionally really simple just to try and demonstrate the points here. So scenario one, the parent just decides to go ahead and encash that segment. They are already earning £150,000, so they are in the 45% income tax bracket. That would mean if they did that, the whole gain would be taxed at 45%, so the tax due would be £4,500. Or hopefully what they would decide to do if they want to actually pass on the money to the child is they would choose to assign that segment to that child. The child doesn't have any other income. They're age 20. Let's say they're at university. The gain would fall within the income tax personal allowance, cover the full gain. So the tax payable in that scenario would be zero. So you can see the importance of ensuring before any encashments are made on an offshore bond that it is checked of what's the optimal way to do that, whether you assign segments, whether you do 5% withdrawals in cash segments. This can be quite a complex area and usually advice is needed at this point. So what are the benefits of placing an offshore bond into trust? Well, it moves the future growth outside the estate, reducing the client's inheritance tax exposure. It lets the settlor retain control over how and when beneficiaries receive funds. So the bond grows without tax being taken out until there's any encashments. And the trustees can withdraw the 5% allowance each year or make assignments for tax efficiency to beneficiaries. Assignments will avoid the trustee rate of income tax. So if you assign segments out of the trust to beneficiaries rather than the trust encashing the segments, then potentially you avoid trustee rate of income tax. A benefit that appeals to trustees is that there's no annual reporting needed if the trust only contains an offshore bond until such point as a chargeable event occurs. So that tends to keep the administration of the trust fairly simple. And for the trustees, the offshore bond provides a flexible, controlled and efficient way to pass wealth on to the next generation. So they can be suitable for some types of trusts. Offshore bonds can be topped up with additional investments over time. Each top-up creates a new tranche within the bond, restarting the clock for the 5% tax-deferred allowance specific to that tranche. So the initial investment and each top-up are treated separately for tax purposes, and each tranche has its own 5% tax-deferred withdrawal facility based on the premium paid in to the top-up. We've got a quick example here. Initial investment of £100,000. That would obviously allow £5,000 per year, or 5%, to be withdrawn tax deferred. There's a top up of 50,000 added after 5 years. That creates a new tranche with a separate allowance of £2,500 per year, and that would start from the top up date. So we've talked about the advantages and planning opportunities of an offshore bond wrapper, and now we just wanted to touch a bit on what are effectively the points to note, or things to bear in mind with an offshore bond. As I mentioned, although the growth is tax deferred, tax liabilities do arise upon encashment of the bond, or when the 5% withdrawal allowance is exceeded. And those gains are likely to be taxed at the bondholder's marginal rate of income tax. Offshore bonds may have higher fees compared to other investment products. The offshore bond provider will usually charge an initial percentage charge, and there tends to be a quarterly administration charge of it's usually about £200 a quarter now. Complexity, I think we've probably shown, as we've talked about the tax here, top slicing relief, etc., that they are more complex financial products, and they do require careful planning and professional advice. And in fact, only professional advisors can actually set these up for clients. Mismanagement of offshore bonds can lead to unintended tax consequences, so they do need to be managed carefully. There is third-party involvement as well. You're bringing a insurance company into the relationship who administers the investment bond. So if funds are required, the funds, for example, if we're managing an investment bond, will be sent back to the offshore bond provider to then pay on to the client. So it's just worth bearing in mind when withdrawals are needed to add a bit of extra time because of that third-party involvement. And ongoing advice can be needed, particularly if a client's looking to make withdrawals from a bond. Typically, they may need to compare using the 5% tax deferred facility with making encashments of segments. They tend to suit larger investment amounts as well. So we would usually suggest above £250,000. For simplicity in the presentation, we've often used 100,000, but actually in reality, they do suit investment amounts above £250,000. And there can be withholding tax, so that's just foreign tax deducted at source. If you have an offshore investment bond and it's invested in funds from overseas, it could be that tax is actually deducted before the returns are reported to the offshore bond. Okay, so before I pass back to Helen, we have had some questions already. And thank you to those who submitted those questions. So I'll just go through, if I may, Helen, the 4 that we've had so far, and then I'm sure you'll jump in if we have time for any further questions. If not, we'll come back to you separately. So thank you for your questions. The first one was, how effective are offshore bonds in planning for long-term residents who've decided to stay in the UK? Well, as we've discussed, really, they can be very effective tools for the target market previously described, because they can, with the right tax planning, they can defer tax and allow the investor to control the tax point. And effectively, they are useful tools for high net worth clients with cash sums to invest. And it might be, as with a lot of our clients, that these wrappers work alongside their other investment portfolios. They may have an ISA, pension, general investment account, they may have trust accounts, and an offshore bond wrapper just gives them some extra flexibility, really. So thank you for that question. The second question we had was, are offshore bonds tax efficient, and what are the risks associated with them? Well, as described, they can be tax efficient if used in the right manner, if you use the facilities they offer, like the assignment, ability to assign, the tax deferred withdrawal facility, because they do defer tax. The risks, I think, as we've covered in the previous slides, that the main point to note is the income tax rather than being subject to capital gains tax. If there was large changes to income tax rates in the future, for example. I'll link that to the fourth question actually, and then I'll come back to the third. Are there any anticipated changes in the upcoming budget which might affect the use of or impact the popularity of offshore bonds? Well, offshore bonds have been around actually since the 1970s, and I think it's important to say, because the tax is paid on offshore bonds when the wrapper is encashed, it's not a way of avoiding tax. The tax is paid. It's just you can control the point at which you pay the tax. There was lots of speculation last year that capital gains tax was going to go up. It did go up, but it didn't go up significantly. I think had that speculation been right, and for example, capital gains tax had gone up to match income tax, then we would have seen even greater demand for offshore bonds. So as with all financial planning products and investment wrappers, they are subject to changes in tax and legislation. And the third question, just coming back to that, was, are there any particular planning opportunities or risks to be aware of when holding the offshore bond in a trust? So we covered the benefits of holding an offshore bond in a trust. The main opportunity is that the wrapper allows tax deferred growth for the trustees, and they then can assign segments out to use the beneficiaries' tax rates as and when that they want to. So gains can be taxed at the lower rates that the beneficiaries have than the trust. The main risks with having a trust holding an offshore bond is, after the settlor dies, if any gains do fall on the trust, then that would be subject to income tax at the highest rate, which would be 45%. So that's when you do want to look at assigning segments potentially to avoid that level of tax. And also the other point to note is poor withdrawal planning can trigger avoidable chargeable gains. So before making any withdrawals, it's always useful to weigh up the options and the ways that money can be realised. Is it through the 5% facility, or in cashing segments, or assigning? So that covers the 4 questions that came in advance. Thank you, and I'll pass over to Helen if there's any more.
Lovely, thank you, Anna. That's great. We don't have any more questions in there at the moment, so by all means, everybody, if you want to put something in very quickly or just a comment, then please do so. But Anna, thank you very much. Obviously, this isn't my specialist area, but that looked like a really comprehensive run through all of that. And it's fair to say that even if you don't have any questions now, if something then comes up once you've gone away and digested this, perhaps looked at it again, then by all means we'll be sharing Anna's details. So I assume people can get in contact with you directly, Anna, if they want some further information.
Sure. Yeah, absolutely.
Fantastic, thank you. And again, obviously J.M. Finn are based here in Bristol, and so do, as Isabel said, let us know if there are other wealth investment topics you would like us to discuss in the future. We're definitely putting more webinars on, there may be some seminars or roundtables, and we also have a private client conference that we run yearly, so we'll be looking to start planning that soon, probably for the spring, early summertime. So by all means, please do let us have that information. And I guess, if you've all got large teams, and it would be helpful to have somebody from J.M. Finn actually come and see you and speak to your team, then again, I'm sure the guys at J.M. Finn will be open to that opportunity. So please just let us know how if there's anything we can do to put you in touch with everybody there. So let me have a look. No, I don't think we've got any more questions in. So Anna, thank you very much indeed. Isabella as well, thank you very much for your introduction time as well. That gives you all about 10 minutes left of your lunch break, so hopefully you can all step away from the screen for a little while and take a breather before your afternoon begins. But thank you very much indeed. As you leave, there will be a feedback form, so there's an opportunity there to let us know what you thought of this session and future sessions. And as we said at the top of the webinar, we'll be sending you a link to this recording and the slides, so that should come out in probably the next couple of days, everybody. But in the meantime, thanks very much for your time and joining us today. Thank you.